Hey guys, Trooper here. So in this video I'm going to be doing a live top-down analysis. I'm going to be showing you guys why I pick the levels that I pick. I'm going to be working my way down from the monthly levels down to the weekly and daily and hourly levels as well. I know that this is a topic that many of you guys have requested for me to answer for quite a bit. You guys want to know why I pay attention to the levels that I pay attention to and how I find them, etc. So that's exactly what I'm going to be covering in this video. So right now I'm starting on the monthly, and I'm starting with a little bit more of a zoomed out view. As you can see, the first thing that I'm looking for over here is support. The primary key order block that I'm looking at is the one near 4,300. Well, I mean, the candle close is around 4,300. You could draw the block in whichever way you like. I'm personally just going to keep it with the candle close for now, but you can draw it with the zone and then do the EQ, or you could just draw the zone around the candle close and open. Either way is fine. You start to redo it once price action starts to get near that level, but for now it's just to market that's there. And then we have our March and April lows right over here at 69.05, and then we also have our April and May highs over here at 9,222. And that would be one of the first resistance levels that we'd look for on the monthly to get a break and close above, to get a signal that we may see higher prices or a continuation of an uptrend from that point forward. For now, just for the video, I'm going to be taking off the levels just so you guys can have a clearer view on each time frame that I look at. But usually what I do is I just mark the key levels on each time frame that I want to have on there, and then I'll work my way down and fit them on the chart and make things look better. Because as you guys can see, if I go into the weekly, then we have this whole mess here. But I'll just be taking them off now and marking my weekly levels. Okay, so weekly levels to mark over here are clearly first of all we can mark our support levels. We have this clear weekly order block right over here that's basically been providing support for the length of this entire bear market. It's a weekly block. This is primary support. A break below this block would probably more than likely induce some lows. I'd probably draw the block in confluence with the volume profile, because as you can see, you can either add the wick or you can not add the wick in the block. I kind of like to just draw my levels where there's confluence. As you can see here, right at the bottom of this level, we have a pretty large gap. So considering that and this view on the weekly, if we were to get a break and close below, we would most likely start to fill this gap. So I'll draw the level right over here. And then over here, we can see that we had a bullish order block on the weekly. You can just draw that. I'll personally just be drawing that with an orange line, just like this. My weekly levels are usually orange. And then I will draw my weekly level here. And I'll draw a weekly level there. And these would be the main order block levels that I'd want to pay attention to. And the reason being for this is because we've seen a lot where these order blocks, where price comes to trade up to these order blocks at least once, even if they're broken through and disrespected. As you can see here, this one's disrespected. In the future, price comes to tap that level. So I'll have this level marked up as well. And I'll draw this one. And so these are going to be my weekly levels. These are the levels to pay attention to. And then I also like to mark up liquidity as well. Liquidity is one of the main things that I pay attention to when it comes to price action. So that's exactly what we're doing. Main weekly liquidity. And then of course, we also have our highs over here. So these are the weekly levels, and from here we'll go ahead and move on into the daily. Okay, so on the daily, there would be quite a bit of things that I would be marking up. First of all, let's just start off with our liquidity. Let's look at these lows over here. Equal lows in June. And we can go ahead and draw a major order block, which that's clearly right over here. To hit bullish daily order blocks, I like to draw in green. Perfect. Then I'll go ahead and draw my daily supply level, which is clear right over here, with an EQ roughly 69.91. I'm sorry, I'm gonna lower that a bit. I usually use a thing to save time. I mean, I usually use the fib tool to measure the EQs. There we go. OCD. But yes, okay, so this would be the primary daily supply that I'd be looking for. This could be considered a daily breaker, potential daily breaker, potential bearish daily breaker to be more exact. And the reason I say that is because it's clear that price didn't see much support here. I mean, it saw somewhat support, but it ended up just breaking through it with no resistance. So you can kind of classify this as a breaker, or you can go ahead and just call it our mitigation block. Also, reason I'm being that I choose this level is because it's at the end of this major volume gap over here that we have yet to fill. If you look on higher time frames as well, you can see this gap is quite prominent. Daily bullish order block at 63.62. The reason I'm drawing this one is because it was the down move which came before this larger up move. It was the candle close is the level that I'm marking up here. And that's pretty much it for the daily. I would probably, no, you know what? That's it. That's pretty much all I would mark up for the daily. I would say that you could probably look to this level over here as well, but because of the fact that it was disrespected here and here, there's really no need to do that. Oh, also forgot to mark liquidity above this very, very clean swing high. And what I also like about this swing high is that it's confluent with this daily supply. It's just below EQ. So if price were to rise just above that, and we got a confirmation rejection off EQ, and it took out this liquidity, maybe if it closed below EQ and below this swing high, that would be pretty good bearish confirmation, and that would be a good setup that we could possibly take in the future. And that was something that I was talking about in the Trooper Education, I'm sorry, the Trooper Analysis channel. So let's see what else we got here. Other than that, I'd probably keep it just like this, real simple on the daily. You could obviously go ahead and draw your daily range. You could also mark up your liquidity on higher levels, like over here on these highs. No need, in my opinion, to do that right now. I mean, those are obviously there. No need to mark them up. But it's good to have these little reminders over here for where liquidity rests and just above here as well. So I'll be watching these levels on the daily. Now let's go on into our hourly levels. When I do my top-down analysis, I usually try to stick to the 4-hour and the 1-hour, but I also do go on the 12-hour as well. And you know what? I'll just keep these daily levels on there for when I go on here. Okay. And as you can see here, we have this hidden supply, which is currently causing price rejection. This is 12-hour hidden supply. And this is why I like to look on the 12-hour. A lot of the times you find pretty important levels on the 12-hour, really clean levels, really clean order blocks. I really like to look at it. I think it's quite useful. As you can see right now, price is hovering within this level. If price were to break out of it, that would be quite bullish, but we're currently seeing rejection. So this is 12-hour hidden supply. I like to mark that in pink. And then that's pretty much it for the 12-hour. You can go ahead and draw EQ for that as well. I won't do that right now. Now let's move on into the 4-hour. And you know what? You could actually, just to make this so much easier for everyone, you could mark this just with a single line. Once we break and close above that line on whatever time frame that you're looking at, in this case it's the 12-hour, you would even do it on the 4-hour. Let's say if we went forward to go on the 4-hour here, order block level is just above here. This is the down move before the large up move. You could say that if we were to get a 4-hour break and close above this OB level right here, then our next target would be this supply. And then again, we wouldn't be seeing rejection here. That would be quite a bullish move. Okay, now when it comes to the 4-hour, there's many other things you could do here as well. In my top-down analysis, as you guys have seen, I like to draw my ranges. I also like to do sell model or buy model analysis as well. So as you guys can see here, the major sell model that I'm currently seeing is this one that's pretty prominent on the 4-hour. Here we have our first equilibrium, or smart money buying, and then we have our first reaccumulation, which we mark up in blue, and then we have our potential smart money reversal up here, which we mark up in gray. By the time you guys see this video, you'll probably see this play out. This is happening, I'm currently looking at this on Sunday. And it looks like it can go either way. It honestly looks a little bit more bearish to me in my opinion, but at the same time, we are uptrending here, so it wouldn't be proper to just start calling tops. We could probably reach this supply over here without much of an issue. So that's our current sell model analysis. If this were the smart money reversal or the distribution phase, then we would begin to see a drop from here, and then possibly, you know, redistribution lower in some way. This is just completely rough. But other than that, that's what we have on the 4-hour. And then what other levels could I mark up here? I wanted to take everything off there just to make things a little bit cleaner, starting to go on the lower hourly levels. We have our hourly order block, which I honestly wouldn't even bother drawing with a zone. I would just draw this, boom, a simple line. We also have our hourly levels over here. Major liquidity resting just below these lows. We have a 4-hour bearish order block. Right over here at 67.19. This was the up move before the down move. The up move before the down move that caused a break in market structure. And I'm using, for this one, I'm using the opening price of the candle. As you can see here, we've had nice reaction towards it. I considered that if we broke above this and closed above on the 4 hour, that we'd probably continue to see a bit higher prices. We'd probably come to tackle these highs at the very least. Then again, I'd be watching this 4 hour level that I marked earlier to see if price were to break above it. And then on the hourly, a few levels we could be watching out for. And I'll just say leave that on there. Bullish order block. $66.30. Sorry. Bullish order block at 66.33. Perfect price tap right there, bounce right off of it, nice confirmation on that level. This is where we'd like to see price hold support for now. If we saw a break below, then we'd probably look to this level for bearish mitigation before we probably see downside. That would look quite like distribution in my opinion. I don't want to see this low tested again. I don't want to see this low breached. If it were, it would begin to look like distribution and look like a first lower low of this trend. As you can see, we've been in a bullish trend. We haven't made any lower lows yet, especially on the 4 hour and 1 hour time frames. So if we came here down here to take out this low, I'd consider that pretty bearish, and then I'd start looking for the two higher, once bullish, now bearish levels for mitigation where I could sell short on an extension. And that's it for the top-down analysis, guys. I don't really tend to go on the 30-minute or anything like that. That's too much noise. It's already a lot just getting down to the hourly. I really like to stick to just the 4 hour and the 12 hour and the higher time frame levels. I look on the hourly for more precise targeting, but at the end of the day, there's just so much noise here that it's really it's that you could find a bunch of levels anywhere you look, really. But it's very easy just to find the simple ones, and that's really all you need, especially when you're trading intraday. Really, I can't see a range that's formed here. Otherwise, I'd be drawing a range. As you can see here, we've only had 1 point down here. You can't draw a range or any line horizontal. There's not at least 2 points connecting it. Here you can draw a range high, but range low wouldn't be viable anywhere here. So I wouldn't even bother. Other than that, guys, yep, that's our top-down analysis. Again, if you guys have any questions, if you guys have any comments, if concerns, if you guys want to know a little bit more, if you guys are wondering how my levels are chosen or anything like that, just shoot me a DM, shoot me a message in the chats, and I'll go ahead and answer it as quick as possible. I really hope that this video helped you guys, and again, remember, please feel free to ask me any questions that you guys like. That's what I'm here for, and that's what Chase is here for as well. We're here to help. So, alright guys, have a good one, and take care. Alright guys, Trooper here. So the question that I'm going to be answering right now is, if there are several order blocks in the same time frame, when do you know to disregard a past block, and when do you know to include it in your analysis? This is a great question. I know this is a question that has confused many of you guys, because it's pretty hard to determine whether a level is significant or not. How do you do that, especially when it comes to an order block? There is a certain criteria that must be met and followed every single time you're marking an order block. And that criteria can be found in my Trooper Education section. If you want to go over it right now, for a bullish order block, it has to be a down move before an up move, which causes a break in market structure. As you can see, we're in this example right over here, we're in an upward trending market. We have this downward move that causes a break in market structure. Market structure is bullish. This down move causes a break in market structure from bullish to bearish. After this down move comes an explosive upward move. The move after the order block handle is very key. It's an explosive move after that order block handle. Then you can 100% verify that this level is going to be a significant level. So as you can see here as well, on the On the 22nd of January, we had the supply cluster that was formed. It was an up move before a down move. We were downward trending. This upward move caused a break in market structure. After this candle closed, we saw a significant dump. That verifies at this level that this order block was a very significant order block, and we're going to want to pay attention to it again. What happens? Price comes off the lows, rallies up toward these highs, hits the order block perfectly, and gets rejected all the way down for a nasty 45% move. So this order block is very significant. Done deal for that one. Now we're looking at this next one right over here. We have the supply cluster that was formed on the 19th of March. We saw downward trending for a while. We saw an up move that caused a break in market structure. After that up move, we saw an explosive downward move that confirms the significance of this level. Price comes up, rallies towards that level. It does find some resistance, but overall it fails to hold as full resistance. It doesn't. The level breaks. We see some rejection off of it, but overall, inevitably the level does break. And then once we top out here, we come dump right back into that level. We find support, as you can see by the wicks. Wicked into it, closed above, wicked into it, wicked below it a little bit as well, closed above again, and then it just dumped right through. Disobeyed it both times. I mean, it reacted to it, but overall it disobeyed the level. However, just because it disobeyed that level doesn't mean that we want to just completely disregard it. Because as you can see here in the future, what did price do? Price came towards that level and found complete rejection perfectly at that level once again. So that's why we want to have that level marked up, and that's something that we could actually be seeing with this level as well, where we saw full rejection. We saw no rejection when it was a supply cluster, and then once it broke through, and when it came to test it as a bullish mitigation level, it found no support again and just completely blasted through. So what could this level be? Although it doesn't have much significance as we've seen, even though the structure complies and price barely reacted to it. So we're gonna have that level marked, and we're gonna see if when price comes up once again, if it tests that level, if it's gonna see rejection at it. If it doesn't, then there's no point in keeping that level even marked again. But at this point, it is a good level to have on your charts just to see and see what price does to it and may do to it in the future. So I know that this can be a lot more confusing, especially on the lower time frames, but this is how it's going to work on the higher time frames. When you're working on the weekly or the daily, you're just going to simply want to look for the order blocks that comply with the structure, and you're going to want to mark those on your charts. If it complies with the structure fully, if you see a significant move after the actual order block candle, then you're going to want to mark that on your charts. And that goes for the significant higher time frames, whether you're looking at the weekly, the 3-day, the 1-day, the 2-day, whatever. That's how you're going to want to look at your order blocks. It's different when you go on the lower time frames. I can say that on the 4 hour, on the higher time frame hourly levels, like the 4 hour, the 12 hour, you're going to want to do the same thing. Make sure your order blocks comply. But on the hourly levels, the lower time frame levels, things can become a little bit more confusing. There's so many more candles, so much more noise to work off of, that there's so much more data overall to work off of, that you can get lost and start marking a bunch of insignificant levels that that really provide not much significance, not much use for you. And I'm going to be going over some of the lower time frame because it's a little bit more complex. I'm going to be going over that in a separate video. But for now, I hope that this one helps you guys in finding the order blocks for the higher time frames. For the lower time frames, I'll cover that in a separate section. It can be a little bit more complex. But for now, I hope this one helps. All right, guys. Talk to you later. Hey, guys. So the next question I'll be talking about is directional bias. Many of you have asked this question and are very interested to know when to switch from bullish to bearish, and vice versa, from bearish to bullish. And this all really depends on what type of trader you are. The lower the time frame that you go on, the more prone you are going to be to switching your bias very, very often. However, if you just go to one time frame, that's the monthly, your bias will most likely be pretty simple, and that's right now it's bearish. Your bias will not change unless we make a higher high. As you can see, this entire bear market, we've simply been having a series of lower highs and lower lows. When you go on the lower time frames, such as the daily, you'll see a combination of some lower highs, but with some higher lows as well. That never fully went into fruition, however. But at the end of the day, all you need to do is come back to the monthly time frame and see that it's very simple. We're bearish. We're not bullish, and we won't be bullish until we begin to break through some key levels. First of all, I want to just note that I'm not bullish until this level is reached. However, I'm also not bullish until this level is broken. Once the highs from April and May are broken, then, and I'm talking about broken fully on to the upside, I'm talking about a full monthly break and close above this level, then that's when I'll start to be bullish. Other than that, I won't be bullish until then. It's very easy to see that we've had just a series of just lower highs and lower lows this entire market, and we're currently, when it comes to a monthly perspective, hovering in this no man's land. We're in between some very extremely tough resistance and not much support in this area. Well, on lower time frames, it's a ton of support. However, really on the monthly, when you come and see here, the biggest area of support next is not until this area on this order block, which if you want to put it on the monthly, then you could say that if you want to just use it by the closes, you can see it's around $4,600. So that's that. Directional bias is extremely simple. If you're a swing trader, then you got to be looking for local resistance areas, local support areas to break above or below that will change your directional bias. If those levels are not broken, then your bias stays the same. It's that simple. Remember that always looking at higher time frames is always going to create the best premise for you. If you're not looking at the higher time frames, then you're most likely doing it wrong, and you're most likely focusing on time frames with very little significance when it comes to the longer term. So yeah, that's pretty much it with directional bias. It's extremely simple, guys. You do the same thing on the weekly. You'd be like, okay, well, on the weekly we're hovering still in this strong order block resistance. I wouldn't be bullish until we have a weekly break and close above 82.60, and then next level would be above 96.84. Once those levels are fully broken, we have upside. We have to look obviously at the weekly level right over here at 12,000. But really, once this level starts to break and this level breaks as well, we really don't have much resistance other than this 12,000 level and all-time highs. Once those levels are broken, it's pretty much, we have much less resistance than there would be support. And then in that case, we could consider that our market would be in full bull mode, and that our directional bias can completely change from shorting tops to starting to find bottoms to long. I don't think that's going to happen anytime soon. I think that we're in a bear market. I don't think this is a rounded bottom. That's going to lead to new highs this year. I mean, it could definitely be. I just don't think so. Then again, that's just coming from a higher time frame directional bias established on the monthly. But then again, we'll see. Alright guys, so I hope this video helped you guys. I know this was a short one, but again, if you have any questions, just let me know in the chats, let me know through DMs, and I'll answer you to the best of my ability. Alright guys, have a good one. Hey guys, Trooper here. So I'm going to be answering 2 questions in this one video, because I feel like these are shorter questions that can be done in less time. Okay, so many of you guys were asking me this question. It's about my kill zone strategies, whether I find using kill zones is effective or important. I do find them effective, usually in certain types of markets. Usually when markets are ranging a lot is when they're more effective. If whatever asset you're trading is in a lot of consolidation, then it may be a good strategy. You may find a bunch of good strategies using kill zones. However, once that asset leaves from a ranging type of market to a trending type of market, the effectiveness of these kill zones become a lot less. And this is something that I've noticed particularly in Bitcoin and crypto, which is what we trade a lot. which is what we trade primarily. So um, over here, I have a few examples of London setups. And usually what I look for when it comes to London kill zones is I look for a Judah swing either south or north, meaning a bearish or bullish um, London Judah swing. So right over here, first example, we have this swing low formed over here. We have a dump that goes down, takes out stops from the swing low from long buyers that bought this previous low. They put their stops right here. Price dumps into that area, takes out the stops, engineers liquidity going into London. Right out of London, we see a pump. This was an excellent setup, and if you were to go back, you would find that price action actually had some key support in this area as well. Here we have another London setup where price pumped into London, taking out the stops from short sellers from these two swing highs, which you could see where it was quite a bit because we did the dump that we saw right after these two swing highs. So price rallies into London open and then is followed by a dump afterwards. That's how you know that this movement here was solely to take out stops before a move lower. And move lower again was simply another maneuver to take out these stops from the swing low before price was to rally higher. Over here we have our third London setup of this range, bullish Judah swing going into London. It takes out stops, and then out of London we see a rally, consolidation, another London setup with a swing high going above this previous key swing high, taking out stops from there, followed by a dump, and another really good setup after this London setup. We saw a breaker right over here, hourly breaker with 0.62 OTE confluence right there, perfectly tapped the 0.62, and then we saw a rally from that breaker back to local highs, just as I've classified my breakers. That's how I usually trade my breakers. If you notice from the criteria that I put in the Trooper Education section about price breakers, I usually look for, when it comes to bullish breakers, I usually look for a move higher right afterwards to recent highs. I don't really look for a move much higher, depending on the time frame. But when it comes to lower time frame trading, I essentially just use breakers for a move back to recent highs. That's exactly what happened here before we saw a massive dump. Okay, so the next question that we're going to be going into is candle closes. You guys asked me a lot about how important I find candle closes and how much attention should you personally pay attention to them as a trader. So this question is very easy to answer, very important. You need to pay attention to your candle closes, especially your monthly, your weekly, and your daily. Your higher time frame candle closes are extremely important. When you're drawing your levels, that's all you're looking for, essentially. All you're looking for, like when you're drawing your daily order block levels, what you're looking for is the daily price candle reaction to your level. If price, let's say you right over here, as we have here, we have a perfect example of a recent daily bearish order block. Price rallied into that daily bearish order block, closed below supply. It went above supply, but then it closed below, and it actually did that twice. So it pierced, above supply, above EQ. It broke above EQ, closed below, above EQ, closed below, twice here in these two daily candles, and then it dumped. And then during this consolidation over here, you could see that it failed once again to reach that EQ and close above, as you can see by this dump. So as you can see, candle closes are very important. And here's another example over here of a daily breaker, a recent daily breaker that I recently traded. We have EQ. I think EQ is a little bit higher than that. But as you can see, price tapped perfectly into EQ, went a little bit below, but closed way above the breaker, signaling a ton of strength off that level. If price were to close below EQ, we would have said, okay, we're going to look for lower support, because obviously this breaker is not giving the type of effectiveness, not giving the type of support that we were looking for initially. But obviously that's not what happened. We saw it close way above, a nice reaction off the EQ, which signaled a ton of strength. So overall, you're going to be looking for your candle closes on every single time frame that you draw your levels on. So if you draw your order block levels in the 4-hour, you're going to be watching your 4-hour candle closes around that 4-hour order block. Same thing with your 12 hours, same thing with your hourly levels, and same thing with your monthly and your weekly. Obviously, your monthly, your weekly, and your daily, those form your higher time frame premise. Those are the most important. But when you're trading intraday and you're looking at your hourly and four-hour levels, it's extremely important to pay attention to the candle closes there as well. And it's the same concept. When you're drawing your order blocks, it just depends on the key level that you're looking for. If you're looking for key levels at EQ, then you're going to be watching for closes above or below EQ. If you're looking at key levels at candle open or candle close of the order block candle, then you'll be looking for closes above or below that level. It's really that simple, and you'll be doing the same thing for the hourly levels, same thing for your 4-hour levels. So overall, that's pretty much it. I hope that these two answers to these two questions helped you guys about the kill zones, which we covered over here, and the candle closes and the levels. So I hope these answers helped you guys. And again, if you have any questions regarding these or any other ones from any other video, just shoot me a DM or tag me in the chats, and I'll get to you as soon as I can. All right, guys. Peace. Hey guys, Trooper here. So the next question I'm going to be going over is, why is OTE valuable? Why do I find it valuable, and why do I use it, and how do I use it? So essentially why OTE is important is because it provides a general measurement that we could use alongside price to determine our entry and exit levels. And not only that, but it allows us to better determine our high probability take profit levels as well. And this OTE is based on Fibonacci levels, as you can see, and it's a tool that you want to be using during a trending market. So I have this example right over here to the left. So let's assume that our market is bearish, meaning that our higher time frame premise is bearish and we're in a downward trending market. What the OTE would essentially allow us to do is, with a higher probability, it would allow us to find an optimal entry to sell an extension before downside were to continue. And it does this through the 0.705 extension level, which is the 70.5% extension level, the 79% and the 62% extension levels. This entire range between the 0.62 and the 0.79 is what's considered your OTE, with the 0.705 being considered the EQ, or the median range, the 50% middle of the optimal trade entry zone. And then with this being your entry, your long exit, because that's what OTE means. It means optimal trade entry or exit. This would be your long exit and your short entry. And then down here at the 0 and the negative 27.2% and the negative 54.4 would be your take profit levels. And then similarly over here onto the right, we have a higher time frame premise, which is bullish. And here we would assume that our market is upward trending, and we're trying to buy a retracement. We would do so through measurement of the 0.705 OTE. From the 0.62 to the 0.79 by drawing a Fibonacci retracement from a swing low to a key swing high. We'd find that level. Typically, we'd look for confluence in that level as well. We'd want to find some support by price, and this is why I say that we could use the OTE as a tool to put alongside our price, because it allows us to add confluence to our overall levels. So this would be our short entry. Let's say you decided to enter short from this local top. You decided to take profit over here. You decided to exit that short, enter long at the 7.5 OTE, bounce there, and then this is where you'd be your take profit, similar to the downward trending market. Your take profits would be the 0, the 27.2, and the 54.4. And this would be if you're assuming that the higher time frame premise is bullish and the market is upward trending again. So here are a few other examples. So these are recent examples on the BTC chart during this downward trending market. So as I've said, what the OTE essentially allows you to do is it allows you to sell an extension or buy a retracement. In this case, we're in a bear market, so we're looking to sell extensions. And here's a few examples. Let me just delete this one so it looks a little bit clearer. Here we have the retracement from the almost 12,000 top to 6,400 bottom. From there we saw a bounce all the way toward near 10,000. We didn't quite break 10,000, as you can see, we had when we draw a retracement from the top to bottom from the fib tool, our extension leads us to the 0.62. Price found a complete rejection at the 0.62. As you can see here, you can add confluence to that if you want. You can draw from this swing high. You could see how price created that swing high for liquidity. You could also see here that if you went on some lower time frames, you could probably find confluent bearish order blocks within this zone. Liquidity was taken here, right above the 0.62 OTE. This tells you that this is a good short entry and long exit if you decided to long at this bottom. Another example would be, let me see here. Another 0.62 short entry and long exit level. If you decided to go long at these local lows, the 0.62 again provided another exact entry, and you could have also added confluence to that by drawing this bearish order block that we had right here with EQ that was pretty confluent with the 0.62. And drop it a little bit lower. You can see that the EQ is pretty confluent with the 0.62. That's of course everything looks great in hindsight, but again, it's all about looking for these levels in real time, practicing them on your charts, and searching how to find them and how to properly utilize them within your analysis. So here's another 0.62 short entry, long exit. Decided to long at these local lows, and let me see if I can find another example. Oh, I have a few other ones over here on this slide. So these are some lower time frame examples of OTEs. So as you can see here, we're in a downward trending market. We know that because we have a low here, which was made during this uptrend. And then we have a lower low here. This was the first lower low of this trend, right? So that's how we confirm that the trend now switched, market structure now fully switched from bullish to bearish. And if we zoom in on some lower time frames, let's say we go to the 4-hour, this OTE provided a perfect optimal entry to switch from a long position if you decided to long from these lows, exit long up here, and enter a short position at the 0.705, provided a perfect entry before downside continued massively all the way down to our 5,800 level. And this was actually a very good trade setup. I traded it myself at this time, and there were a few others as well. I pulled these all up because I remember trading them. There's more examples on different assets like ETH and things like that. I can pull up some examples later, but right now we're just going to be focusing on Bitcoin. Here's another example right here. So assuming that we're in an upward trending market, obviously that this was a wrong assumption to make because of the fact that we bounced off these lows, so we could be starting an upward trend. However, and it was confirmed because we had a low here and a higher low. We did move up higher from that 0.705. However, it wasn't much of it did a full retrace right after that bounce, and then it really wouldn't consider this a higher time frame bullish premise. But still, when you have such a deep retracement and you're looking for some bounces to play some longs off of, you could use your 0.75 OTE for lower time frame bullish structure. So here we had a higher low that was formed, and it bounced perfectly at the 0.705 OTE. If you decided to head short here, possibly from a long position down here, which is exactly what I did. I exited that short position here, added to my long once again, and then exited up here at these highs. This provided an excellent entry. Let's see what else. Oh, this is one of the more significant ones that we've seen occur lately, and this one had a ton more confluence because, as you've seen from my analysis, the ones that I pointed out in my Trueco Education channels, here was a perfect 0.705 OTE entry, but it occurred precisely at this bullish breaker, which at that time was a potential bullish breaker. We couldn't confirm it until it confirmed itself by reacting to that level. But it was a perfect 0.705 OTE entry. So what happened here was what we saw: deep retracement. And then finally, when we saw a significant bounce off of our lows, the most significant bounce we saw during the entire life of this trend, we saw a higher time frame, higher low, which confirmed that the market structure had just flipped from from bearish to bullish. And that higher low occurred exactly at a 0.705 OTE and bullish breaker entry. It was a prime entry, prime position to take based off of a bullish higher time frame premise, and that's exactly what happened. We saw a massive bounce off of that level, followed by a continued rallying toward the 0.62 OTE that we had mentioned in the previous chart over here. Oh, they got deleted. No big deal. But yes, that's exactly what I was talking about. Alright guys, so I hope that this OTE video helped you guys out a bit. If you guys have any questions, continue about this topic, just let me know in the chat, send me a DM, and I'll answer them as soon as I can. Alright guys, have a good one.
So one of our next questions is, what is the purpose of a candle close? You know, it's a sort of non-specific question, so I don't know exactly how to answer it, but I'll answer it as I see it. Candle closes are important because, you know, it's self-explanatory, but you don't know where the candle is going to close until it closes. You know, it could look bearish and then turn bullish, of course. Another reason why candle closes are important are, you know, they depict where, you know, things print. So if you're looking for like an RSI divergence, the RSI won't print until the candle closes. If you're looking for a swing failure pattern, you can't have confirmation on an SFP until the candle closes. And then you also just have your typical, you know, candle formations, you know, like a shooting star, or you know, bullish engulfing, hanging man, hammers, you know, all these that you can follow, but of course they won't form until the candles close. So I know that's sort of a basic explanation, but you know, you look for you know, double bottoms. Okay, so you get like a strong double bottom, you typically know an uptrend is going to begin. You know, things of that nature. Okay. Okay, so next question is about directional bias. When do you switch from bull to bear? Truth be told, I've been, you know, I sold most of my Bitcoin up here back when, you know, I only got into crypto, you know, a year and a half ago or so, and I sold, you know, right around here, right around the top, around 17,000. I sold Litecoin at like $370 or something. Point being is, you know, you have to be bearish, in my opinion, until the bear market ends. It's really that simple. All we do is make lower highs. So we make a lower high, 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 we make a lower high. So will we continue to make a lower high here? And then maybe if we make another lower high, we finally break down. Okay? And if this happens, right, if we go up and we make a new high, in my opinion, we're no longer in the bear market. We have now made a new high. You know, show me a daily close above. You know, show me a daily close above here, and I'll say we're out of the bear market. And it's not a matter of directional bias. I don't think you should be biased on a day-to-day. I think you should just be simply trading day-to-day, and you know, utilizing what the market gives you. At the moment, you can see as we're zoomed out, literally the market is not, it's hardly providing any opportunity. Look at all these days just stacked up in a row in such a tiny area. Rarely has the market gone so sideways like this. If we do break north, there could finally be a potential of breaking the lower high streak, because this consolidation is just so weird, to be honest with you. So yeah, I'll definitely be, you know, I'm watching and I'm waiting, but until, you know, we break the lower highs, as far as directional bias goes, I'm never biased. I'm always 50% pretty much on Bitcoin, 50% on USD. You know, I try to sell a lot, and you know, I try to keep some of my holdings as well. I wouldn't say I'm a bull. I wouldn't say I'm a bear. I sold the top. I sold some more at 7,000. Some would be saying, "Oh, you sold the bottom." I don't see it that way. Okay, I see it as now that I have a great average sell in the middle here. You know, I've sold basically the middle of the market, and if we decide to go bullish again and we break above this high, well, then I'll look to get back into more Bitcoin position most likely. But until then, you know, as far as I'm seeing it, it's still bear market. And I would say bear market doesn't, like I said, bear market doesn't mean constantly search for shorts. It just means that you probably shouldn't be bullish unless there's a great reason to. And you know, besides, you know, I mean, what did we see? We touched and we bounced strongly from yearly lows. Sort of the only bullish thing I really see here. But just because we bounce from yearly lows doesn't mean the bear market's over. It doesn't mean we've made a higher high, or we broke the streak of the lower highs. So, you know, it's just a matter, for me, it's a matter of trading day by day. And unfortunately, lately, I mean, this is the most sideways we've ever been. I'm not sure if we're gearing up for a big pop or a big drop, but we shall certainly see. Okay, so how does VPVR help when the gaps are constantly changing? You need to utilize VPVR depending on, you know, it's an indicator like anything else. You want to figure out the time frame you're utilizing it for. So if you're looking for daily support and resistance, you know, you switch over to your daily chart and you'll find your levels. Okay, if you want to use it for a scalp position and you're on the 15-minute chart or you're on the 5-minute chart, then that's your gaps on that time frame. So it's not a matter of, you know, you can't look at this and say, okay, well, 6,400 is support on the daily, and whether it is or not, but I don't think it is. Let me check. In terms of my daily chart, I have support not at 6,400 but at 6,294. Okay, so you know, there's no, when it comes to the VPVR, you just have to utilize it for what time frame you're looking to utilize it for. And obviously the more data you get, the more precise it's going to give you a reading. Okay, as always, it should just be simply used for confluence. It's not something where you say, oh, well, VPVR shows support here, so here's support. No, just, you know, plot out your support and resistance levels, use your VPVR for confluence, see if it's also showing that there's a lot of volume in that area. Typically, if there's a lot of volume in the area, it could mean that a lot of people open positions at that point, and they're going to look to protect that point. You know, that's why you can see them as support. So you could see today that there's been a lot of volume. Let's see, today is the 22nd when we started. So from the 22nd, we've seen a majority of our volume right around the 64.21 level. And then we also saw strong volume down around the 63.15 level. Okay, so these would be the levels I'd be watching for as support, and you can see them align pretty perfectly with the levels here. Okay, look, see that level right there, and then you're getting support all along this. It's bouncing along, it's finding resistance here. Look at the tap of the resistance, support here, support here. You see the support, okay, and down here obviously you have a few touches there as well. Okay, so that's how you want to use your VPVR. Use it for the time frame you're looking at, and use it as confluence, not as specifically. You can't chart 15-minute VPVR and say it's good for daily. Okay, it would be the same as you can't use a 15-minute Ichimoku cloud and say, oh yeah, well, the cloud stops here, that's got to be daily support. No, you got to use the indicator for the specific time frame that you're looking at. Okay, next question is about entering swing failure patterns without waiting for confirmation. I will say first and foremost that I'm the type of person who likes to wait for confirmation. I think it's it's the safer trade to do, and there's always a chance that if you're not waiting for confirmation, you could simply blow through the zone, and then you're just taking a stop out for no reason when you could have simply waited for confirmation. If you don't want to wait for confirmation, then here's what you could do. Pretend you're trying to play the swing failure pattern off of here. What I would personally do is I would probably, what you can do is you can either have, you can go for like a snipe order, right? So you can set one order, and then you can have your stop loss set, you know, below what you would believe is a near support. So this is the beginning of the support area. This isn't a great example because, you know, depending on this support area, you may not want to, you know, have a stop in another support area. So what you could do here is you could layer. You could either, you know, do your typical limit order here with a stop loss, you know, give it, say, you know, I would just, if I was to go in at 57, right, or if I was to go in at like 57.32, let's say, for this SFP, I'd probably just shoot for 55.99.5, okay, because a lot of people like to pile their orders on top of even numbers, so there'll probably be a lot of orders at like 5,600. So that would be a stop out of, let's see, if you were at 57.38 or 57.35, somewhere right around here. If you were going for a one-shot snipe and you were going 55.95, then you're looking at about 135 point stop. It's not terrible, it's also not great. Okay, so what's another option that you could do there? Well, you could certainly keep that same exact stop loss, right? But what, instead of just going for one snipe order, you could layer. So you could go 57.40, you could go 57, and then you could go 56.50. Okay, and now you have 3 layers, and your average entry price is going to be right in the middle here. And compared to your stop, now your stop's only going to be 100 points away, okay, instead of 140. So what's, you know, it sounds great and all, what's the downside to it? Well, the downside is that you may not get all your orders hit, okay? So that's something to consider. Do you think all your orders are going to get hit? You know, if it's a situation where there could be panic, like this one, because we'll be forming new yearly lows, then I would say that, you know, a layering play is probably not a bad idea, because you have to watch out. And truthfully, you know, when regarding this whole area, you know, a layering play, low leverage throughout the whole thing might not be a bad idea. But we'll talk about that more specifically if it gets closer. I just wanted to, you know, for this video, let's pretend that this isn't a potential upcoming trade, and, you know, just leave it at how I just talked about it, with the either, you know, the snipe or the possible layers, depending on how you want to look for your, or depending on how you want to utilize and where you want to set your stop loss. Okay. Okay. Another question is when to take profits, especially on scalps. Well, I think it's pretty much depends on, you know, where the you know, support and resistance levels are. So if you're aiming specifically on scalps, you should have you know, your levels laid out on small time frames, and then simply you know, find your level. So find your level of resistance, say, and then I personally like to pull back about, like, you know, 12, 13 points to, you know, sort of front run everyone else who may be looking to close at resistance, and that's how I close. You know, what will I do there? I'll close about, you know, typically 50% of my position. I try to get about 80 or 100 points, somewhere around there, you know, between 70 and 100. And then once I get to that point, I'll set my other 50% of my position to my entry price, and it's a winning trade. I keep a green trade green just about every time. You may have known that that's my motto by now. So that's what I would do specifically for scalping. You know, I'm looking for that quick, you know, even if it's a quick 50 points, sometimes, you know, if the trade is a sketchy trade, right, if you feel like, oh, this trade is a little too risky for my taste, then when you're in 40-point profit, close, say, you know, 30% or 50% of your position, right, for about 30 points, and then you can actually add, instead of setting your stop to break even, right, if you close 50% for 30 points, you can actually add 30 points to your stop loss, and hope that, you know, your stop loss doesn't get tagged if you're fear of it getting tagged, and let the other 50% of your position ride at basically a break-even price. Okay, hopefully that makes sense. So those are the type of things I look for when I'm scalping. So a very popular question was about stop losses and risk management percent. Personally, you can find all my risk management you know, in percentage used per trade and whatnot within the Discord. It's in the Words of Wisdom. Trooper also has his in the education section. I would simply say that, you know, it does depend on stack size, right? So for someone who is, you know, if let's say you're brand new to the crypto market, you bought 0.5 Bitcoin, and you hear people talking about trading with 1 to 2% of their portfolio, and you say, oh, well, that's not possible for me, I'm never going to make any profit. I certainly understand, okay? But at the same time, do understand that if you start losing capital at a fast pace, the amount of gain required to make it up grows increasingly and increasingly, and it gets very out of control very fast, to the point where it's very hard to, because you have to use less and less capital if you're sticking to a risk management plan. So for someone who's in that position, you know, if someone only has 1 Bitcoin or something, I can't recommend utilizing more than 0.05 per trade, and you still need to stay around, at worst, you know, 10x leverage or 25. 20, I would say, you know, 10 is really where you should be. You know, if you really need to be higher, you know, you can maybe look at 20, 25. But, you know, like I said, it's really a matter of, you know, what a professional trader does is basically use anywhere from, you know, just about 1% per trade. Okay, you know, 1% per trade. And, you know, for me, in terms of how I set it up, I typically risk, you know, 1 to 3% per trade, and my stop loss always varies a bit. So it's never exact, but for me, I'm always the type of person, like I said, keep a green trade green. So I try to find good risk reward trades, you know, 3 or higher typically. And when the trade goes into profit by more than 70 points, I typically cut, like, you know, 30 to 50%, and I set my stop loss to break even. And over time, when you're doing that, it just keeps building and building and building and building your account. And stop losses shouldn't be set at just a specific number. You don't say, oh, I'm scalping, well, my stop loss is going to be 50 points. Oh, I'm doing a swing position, my stop loss is going to be 200 points. It has nothing to do with that. When you're setting your stop losses, you should be looking for the point where your trade is invalidated. Okay? So find your support levels, find your resistance levels, mark your ranges, and that's where your stops have to be. If you can't find a solid risk-reward trade with utilizing a stop loss below that support or resistance, then you don't have a trade. It's as simple as that. Okay? So that is how I utilize stop loss, where I put them, and how much I risk, and, you know, percentage-wise. Okay?